Hey guys, welcome back. We're still continuing with the question four of the November 2016 question paper. And then in this one, we're going to be answering question 4.2.2 and moving right to the bottom of 4.2.4. So stay tuned and hope you benefit from this lesson. Cool, let's go. So the question that we're answering here is calculate the following amounts for the cash flow statement. You want to calculate the change in loan, and then after that, you're gonna calculate the income tax paid. All right, we got our answer book right here to calculate the change in loan and also to calculate the income tax paid. So let us go. So the first thing that we want is to actually check what is the change in the loan amount. So here you have an extract of the balance sheet. And then there's no other information about the loan except here in the balance sheet. So if you go to your liabilities, so you have a loan here, Barbie Bank. You can see that in 2015 you had a loan balance of 4,500,000, and then you see that in the following year you have a balance of 8 million. So you can see that we took more loans. So if we take an additional loan, it means that an increase in our cash position. So let's go there and say the change in loan in the cash flow statement would basically be 8 million. Will be 8 million, and then we'd subtract the balance at the beginning, which was 4.5 million, and then you'd have a loan balance of 3.5 million. This is an inflow of cash, obviously, because if you're taking more loans, then it means that you're getting more cash into the bank. It might mean cash out later, but at the moment you're taking it out, you have more balance in your bank account. So that's an inflow of cash. And then they say in the following question, calculate the income tax paid for the cash flow statement. Okay, cool. So with this one as well, the first thing that we start with the SARS income tax, and then at the beginning of the year, and then we go to the income statement to find the income tax for the year, and then after that we go and check the loan amount at the end of the financial period. So this is how it is going to go. So let's look at the SARS income tax 2015. So you have 23,400. That tells you that at the beginning of the year, the company owed 23,400 to SARS. So if they had that money that they owed to SARS at the beginning of the year, it means that they would pay it this year. And then after that, we go and take the income tax for the year. So we're going to assume that they paid all that amount. And then we go and look at the end of the year. At the end of the year, it seems like they still owe 6,200. So it means that of this amount that should have been paid, 6,200 was not yet paid. So this is how we're going to do it. Obviously, going to take the 23,400 because we'll say that one is a minus on cash for the year. And then we're gonna go to the income tax for the year, and then we say minus. And then because 6,200 is still owing at the end of the year, we would have to add that because it means that it hasn't gone out of the business just as yet. But if we didn't have any balance at the end of the year, if the balance was zero, then if the balance is zero, it would mean that you have paid all that income tax in the income statement, and therefore would only take the negative 23,400 to the negative 190,500 and not do anything with the, well, we wouldn't have it. Yes, and then the answer to that would be negative 207,700. So you know this is an outflow of cash. So that's your first question, and then the question that follows after that is calculate. Let's go up. So they say complete the extract of the cash flow statement for cash and cash equivalents. So this is when you're calculating the net change in cash and cash equivalents. So let us go. So, well, we're going to start with cash and cash equivalents. Cash and cash equivalents. On July 2015, that is the beginning of the year. And then after that, let me just copy that. And then we go cash and cash equivalents at the end of the year, which is 30th of June 2016. And then after that, let's go and check out how we can calculate this. So at the beginning of the year, we had cash and cash equivalents of 7,500, but also had a bank overdraft. So this would be 7,500 minus 610,500 to get the cash equivalents at the beginning of the year. So obviously had a negative amount. So we would have negative 610,500, and then we'd say plus 7,500 for the cash and cash equivalents at the beginning of the year, and then we would have a total of 603,000, and then the cash and cash equivalents at the end of the year. So we can see here that we have 205,000, and then we have nothing on the bank overdraft, so that we would know then that at the end of the year we have 205,000. That is a straight given. Let's just make sure that you edit this one out and make sure that it's negative, because a bank overdraft is negative. So our overdraft is bigger than what is sitting in our cash and cash equivalent. And then after that, the net change then would be, obviously, if you are adding from the top to down, you'd say net change minus cash and cash equivalents at the beginning of the year, and then you'd get the 205,000. If you want to get the cash and cash equivalents at the end of the year, you'd have to say 205,000 plus 603,000. That's what you'd have to do, and in that situation, you would get what you would get is let me just calculate it now. So obviously we'd say so 2 plus 6, that would give you 8. 0 plus 0, that's 0. 5 plus 3, that's 8. And then you'd have 808,000 for net change in cash and cash equivalents. Cool. And let's move forward and look at the rest of the other questions that we need to answer. So the question that follows after that, they want us to calculate the asset test ratio, the debt equity ratio, the average return on shareholders' equity, as well as the net asset value per share. So in order to calculate these, obviously start with the asset test ratio. We know that the asset test ratio is current assets minus trading inventory, or minus inventory. So it would say current assets of 1 million minus inventory, and then is to current liabilities. The alternative to that, you can simply say trade and other receivables plus cash and cash equivalents, and just leave out the inventories. So it depends how you approach it. In some situations, you may not be given the inventories. So in that case, you just have to take these two and add them together. And then say is to current liabilities. Cool. So let us go. So asset test ratio, we know that the total non-current assets is 1,015,000, and then we'll subtract the 564,000, which is for stock. And then after that, we'll put the amount for liabilities as well, which is 635,200. Cool. And then if you put that all together and add a calculation, you know that you'll always divide by the side of the non-current by the side of current liabilities, and you would get a current ratio of 0.7 is to 1, because you will divide by 635, 200 on both sides, and you'll get 0.7 is to 1. And then moving on, calculating the debt equity ratio. With the debt equity ratio, you know that it's non-current liabilities. Sorry, it's non-current liabilities to equity. So non-current liabilities, I'm sure you know that it was the 8 million that you actually spoke about in the other question for the loan. And then you'd say to equity, what is our equity? Well, the total equity is 10 million. So you can see the loan Bobby Bank, that's the non-current liability, and then the equity is 10 million and 50,750. So it is to so is to 10 million 750, and then you know that we will divide by the right hand side, which is 10 million 50,750, and then we would end up having 0.8 is to 1. And then the next ratio is calculate the average return on shareholders' equity. So this one, it would be net profit divided by the average shareholders' equity multiplied by 100. To calculate average shareholders' equity, you take equity at the beginning, add to equity at the end, and then divide that by 2. So let us do that. So what is the net profit? So the net profit is 444,500. All right, let's start with that. So we're going to say we have equity of 444,500. And then we'll say divided, as I said, to calculate average equity, you'd have to add equity at the beginning as well as equity at the end, and then divide that by 2. So what we'll do here is that the equity at the end, we already know it's 10,050,750 plus, let's check the equity at the beginning. The equity at the beginning is 9,540,000. 9,540,000, 9,540,000, and then you'd have to multiply this whole thing by 0.5, which is basically 1/2. So let's put big brackets. So you add that, all that's in your denominator, you'd add, and then you put these big brackets here, and then multiply by 0.5, and then you then multiply the whole thing by 100. And then your return on equity would then be 4.5%. So that's a return on shareholders' equity. And lastly, they've asked us to calculate the net asset value per share. To calculate the net asset value per share is basically equal to shareholders' equity divided by, it's shareholders' equity divided by the number of shares, and then you multiply by 100 and you measure it in cents. So we know that the shareholders' equity is that 10,050,750. You divide that by the number of shares, which you have calculated in the other question here, and say that you have 950,000 shares in issue. So you'd say divided by 950,000. I don't know what's happening there. So divided by 950,000, and you multiply this whole thing by 100, and that would give you 1,058 cents, or rather 10 Rand 58, whatever, which one you decide to go with. Okay, and we're gonna end the lesson there for now, and then in the next lesson we're gonna answer the rest of the questions. Thank you guys for joining. Tune in the next lesson. Cheers.